Welcome, everyone. Today's explainer is a full masterclass on the Chapter 18 Stamp Taxes syllabus, specifically updated for the Finance Act 2024. If you're gearing up for the 2025 BPST exam, you are in exactly the right place. I'm going to take this at a very measured, deliberate pace today because, well, the rules here are incredibly precise. To absolutely nail this exam, you really need to understand exactly how these distinct tax regimes operate without blurring them together. So let's just jump right in.
Here is our mental blueprint for the session. We'll start with an overview of UK stamp taxes, then look at stamp duty on paper shares, followed by SDRT for electronic transfers. After that, we'll dive into stamp duty land tax, tackle enveloped dwellings and ATED, and finally wrap up with exam strategy and some special cases.
All right, part one, an overview of UK stamp taxes.
Listen carefully and really try to lock these three distinctions into your memory. Stamp duty, that is strictly a tax on paper documents. Stamp duty reserve tax, or SDRT, is for your electronic share transfers. And stamp duty land tax, or SDLT, is exclusively for physical land and property. You definitely don't want to mix these up in your written answers. Examiners will immediately deduct marks if you use the wrong terminology for the wrong asset class, so keep them firmly separated in your mind.
Moving on to part two, stamp duty, specifically on paper shares.
Now, what's really vital to understand here is the rounding rule. Stamp duty is charged at an ad valorem rate of 0.5% of the consideration paid, but here is the trap you need to watch out for. You must strictly round up to the nearest £5. So think about it like this. If your calculation gives you £47 20 pence, you must round that up to £50. If it gives you exactly £50, it just stays at £50. But if it calculates to even £50 and 1 pence, you are forced to round all the way up to £55. Pay super close attention to this when you're writing out your workings.
Another crucial detail is this de minimis threshold. If the total consideration for that paper share transfer is exactly £1,000 or less, stamp duty is simply not charged at all. It drops straight to zero. And the logic there is just to exempt small, everyday share transfers between private individuals.
Let's transition over to part three, SDRT for electronic transfers.
The contrast between these two share regimes is a classic trap that catches so many students. Both systems share that baseline 0.5% tax rate. However, SDRT requires a precise, exact calculation with absolutely zero rounding. Seriously, do not apply that £5 rounding up rule to electronic CREST transfers. The examiner is actively looking to test if you know the difference between calculating for paper versus calculating for electronic.
In practice, SDRT is typically collected automatically via the CREST system, 14 days after the trade date. If you happen to settle outside of CREST, it's due by the 7th day of the following month. You'll also want to note the exemption for AIM securities. Securities admitted to trading on the alternative investment market, assuming they aren't listed anywhere else, are totally exempt from SDRT. It's a nice little rule to support growth capital. Oh, and remember the cancellation rule. If a paper stock transfer form is later produced and actually stamped, the SDRT charge gets canceled to prevent you from being double taxed on the exact same trade.
Okay, part four. We're leaving shares behind and getting into stamp duty land tax.
I'm going to speak a bit slowly here so you can really absorb these bands. These residential rates operate strictly on a slice basis. What does that mean? Well, it means each rate only applies to the portion or slice of the purchase price that falls within that specific band. So it's 0% up to £250,000, then 5% on the slice up to £925,000, 10% on the slice up to $1.5 million, and 12% on any slice above that. You just calculate it layer by layer, exactly the same way you would handle income tax bands.
Now, examiners love to test your layered knowledge here. If a buyer is purchasing an additional residential property, like a buy-to-let investment or maybe a second home, you have to add a 3% surcharge to every single rate band we just talked about. Furthermore, if the purchaser is a non-UK resident, boom, there's another 2% surcharge. And yes, these surcharges stack on top of each other. So an overseas investor buying a second home, they are paying both the 3% and the 2% on top of all those standard residential rates.
You absolutely must memorize this hard limit for first-time buyer relief. A qualifying first-time buyer pays 0% on the first £425,000 and 5% up to £625,000. But listen to this. If the property costs literally a single penny more than £625,000, this relief completely vanishes. It is a harsh cliff edge. They instantly revert back to the standard residential rates on the entire purchase amount. Huge red alert for the 2025 exams. Multiple dwellings relief was entirely abolished on the 1st of June 2024. Do not apply multiple dwellings relief under any circumstances in your calculations. The examiner will almost certainly throw multiple residential purchases into a single transaction just to try and tempt you into using those old rules. Do not fall for it.
Let's look at commercial real estate. If a property has even a tiny commercial element, say a retail shop, with a residential flat situated right above it, it's classed as mixed use. This is highly beneficial for the taxpayer because you get to use these significantly lower non-residential slice rates. We're talking 0% up to £150,000, 2% up to £250,000, and capping out at a maximum of just 5% above £250,000. Always check the exam scenario for mixed-use elements.
Part 5. Let's tackle enveloped dwellings and ATED. So, if a company buys a residential property for more than £500,000, those standard slice rates we just learned, throw them right out the window. They are completely replaced by a punitive, flat 15% SDLT rate applied to the entire purchase price. This is a strict anti-avoidance measure. It's specifically designed to make holding high-value homes in corporate envelopes exceptionally expensive. And the pain for these companies doesn't stop at that 15% purchase tax. On top of that, the company must pay the annual tax on enveloped dwellings, or ATED, every single year. The property is revalued every 5 years, with the current baseline set at April 1st, 2022. However, you do need to be aware of the exemptions. If the company is running a genuine commercial letting business, meaning they're renting to unconnected third-party tenants at market rates, or if they're acting as a property developer or a hotel, they are exempt from ATED.
Finally, Part 6, Exam Strategy and Special Cases. Let's bring it all together.
When you're tasked with advising a sole trader on business incorporation, you must highlight the hidden SDLT cost. If they transfer their business premises over to the new company, the company pays SDLT based on the open market value of that land. And this applies even if it's a pure paper transaction where absolutely no cash changes hands. Conversely, the sole trader pays zero stamp duty on the new shares they're issued, simply because the issuance of new shares isn't considered a transfer.
Now, let's look at the exact opposite scenario, a corporate liquidation. When a liquidator distributes property or existing shares back out to the shareholders, it triggers zero SDLT and zero stamp duty. But the absolute key condition here is that the shareholders must not pay any consideration for those assets. If they pay anything at all, the normal taxes apply.
Across both stamp duty and SDLT, group reorganizations will frequently test your knowledge of the 75% group relief rule. Basically, transfers of shares or land between members of a 75% corporate group are totally exempt from tax. But your exam advice is going to be incomplete unless you flag the clawback risk. If the company that received the asset leaves the group within 3 years of the transfer, that relief is aggressively clawed back by HMRC. Just one quick geographical note before we wrap up. Maintain a general awareness that Scotland and Wales have their own devolved land taxes. Scotland uses the Land and Buildings Transaction Tax, and Wales uses the Land Transaction Tax. Do not waste your precious revision time memorizing their specific regional bans and rates. The BPT syllabus only requires you to know that they exist and that they apply instead of SDLT in those specific jurisdictions. Well, we've covered a tremendous amount of ground today. Review this masterclass until you can confidently and instantly separate paper shares, electronic shares, and property in your mind. But remember, tax law is a living, breathing entity. As you master these 2024 rules to absolute perfection, it leaves you with an interesting thought. As the economy shifts, what new loopholes will the government be forced to close next year? Thanks for joining this explainer, and good luck with your studies.